Okay, we're gonna go ahead and get started. Just a reminder, we're gonna work this problem today in class. Wednesday is gonna be the quiz. No class on Friday, so don't show up on Friday. In my last class, this took about 20-25 minutes to do, so class should be pretty short today. When we did the lecture for this chapter, there's several components of it that we're not really going to touch on for this quiz. This is basically just going to look at doing the allowance for bad debts for regular accounts receivable. So we're not going to talk about notes receivable in the quiz. Not really going to talk about credit card sales. Just going to specifically focus on this part for the first quiz. Like I did on the last chapter, there's still going to be a second chance quiz, and hopefully on each chapter we do for the rest of the year. So the quiz that we do on Wednesday in class will look very much like this with different scenario and numbers. And then the second chance quiz, if you didn't take it before, is basically true, false, multiple choice. Again, it will be maximum 80% that you can get on that. So if you don't come on Wednesday, or you end up doing really badly on the Wednesday quiz, that one will open up on Wednesday as well, and I'll leave it open until the end of the semester. Okay, so we'll just go on to this problem for today. Basically what we have here is the two relevant lines from a balance sheet that would deal with accounts receivable for a company that has a lot of accounts receivable, and also the allowance for bad debts. Okay, this is as of December 31st of 2014. We're looking at these two lines of the balance sheet. So the first requirement here basically just asks you, looking at those two lines of the balance sheet, if you're an investor or someone who's evaluating this company, what is the real net realizable value of these receivables? Okay, it's a pretty straightforward question. Basically just asking, even though we have $60,000 worth of receivables there, obviously that $2,000 allowance tells us something, and what it's basically telling us is we don't expect to collect $2,000 of the $60,000 accounts receivable that we have there. So for requirement 1 right here, I would just take my accounts receivable balance minus allowance for bad debts equals 58,000 in this case, which is the net realizable balance. Okay, so obviously it's not hard to do 60 minus $2,000. We're not testing your math skills here. This is just asking basically, do you understand if that's on a balance sheet what that means? Okay. So that should be easy points for you on the quiz if you're asked that. Let's move and look at requirement 2 here. So the first part of requirement 2 gives us these three kind of aggregate totals for the year in these categories that we need to do a journal entry for. So we've got total credit sales for the year, 80,000. And then the amount of cash payments we received to pay off existing accounts receivable for the whole year was this amount, $74,300. And then we had $2,700 worth of accounts that actually became uncollectible for the year. Okay, so at the end of last year, we estimated $2,000 would not be collectible for the year. And then during the year, what the actual number was this number, $2,700. So $2,000 estimate, $2,700 actual amount that was uncollectible during the year. Okay, so the first part of this is we need to do a journal entry for each of these three categories right here. And then for two of the applicable accounts, we're going to do the T-chart just to see what the balances in those two accounts are. Okay, since these, obviously these are not journal entries like we would probably see them in real life, because we only have one journal entry that records all of the credit sales for the year. Okay, That's just for simplicity's sake, so we don't have to go in and do a year's worth of journal entries where there could be 25 or 50 or 100 different accounts that make up these account receivables. Okay, so we're just combining them all into one journal entry. We're combining all of the payments we receive into one journal entry, and we're combining all of the uncollectibles into one journal entry. Okay, so because we're combining them like that, our date is just going to be the last day of the year. Okay, and the question itself says here we don't need to do any explanations. So all we need here for these journal entries are the account names and whether it's a debit or a credit in each account. Okay, so for A, total credit sales, this should be fairly simple for you all because we've worked and done journal entries like this throughout the year. But we have a debit to accounts receivable for the entire amount, $80,000, and a credit to sales revenue for $80,000. Okay, so there's no tricks with any of these really. Just record the accounts receivable there, and obviously probably easiest to as we journalize these to look and see if any of the journal entries we do touch either of these two accounts, because the question asks us to do the T-chart for these two accounts. Okay, we see that this first entry does touch accounts receivable, which is one of the accounts we're looking at. So to do the T-chart for these two accounts, we need to first make sure that we have the opening balance right in those accounts. And that's what these numbers right here gave us. Okay, at the end of December 2014, these were the balances in these two accounts. So I'm going to put that in there as my opening balance, and a credit of $2,000 in my opening balance there. Now all I have to do is, as I'm doing these journal entries, if I see any of these two account names appear in the journal entry, I just do whatever we did in the journal entry on the T-chart. So in this case, we've got accounts receivable, debit $80,000. So I will just put that right here. Okay, sales revenue is not one of the two that I'm looking at here, so I don't need to do anything on that side. Next journal entry for B here, again, we're just going to assume that we're doing this on the last day of the year. And it says, I received, as the company Monarch, cash payments that were paying off some of these accounts receivable for a total of $74,300. Okay, so obviously if I'm receiving cash in the amount of $74,300, my first entry is going to be a debit to cash for that amount. Cash is not one of the two accounts I'm looking at for the T-chart, so I don't need to record it there. My credit is going to be something to reduce what's in my accounts receivable account, because I need to show that $74,300's worth of accounts have now been taken care of or paid off. So my accounts receivable is going to be credited so that it goes down by that amount. Okay, and again, accounts receivable is one of these two accounts, so I will do what I did here, or credit accounts receivable for $74,300. Okay, everybody with me so far? And for the last journal entry, again, just assume last day of the year. And now this journal entry again is telling us that even though we estimated $2,000 worth of bad debts for the year, our actual number was $2,700. Okay, so these are, when I figure out the actual number, this is when I'm actually writing off the debt. Okay, it's no longer an estimate. I'm writing off this debt for this amount. So I want to reduce my allowance for bad debts. Okay, so instead of a credit, I'm going to debit allowance for bad debts. in the amount of $2,700. And I'm going to credit accounts receivable for that amount. Okay, so what I've basically done is I've said $2,700 worth of the accounts that still remain in the accounts receivable account, we don't expect to collect anymore. Okay, so I need to reduce this account by $2,700, which is what the credit side of that entry did. And I need to take my estimate for the year and show that I not only used all of that up, but also went the other way and went over what my estimate was going to be for the year. So instead of having a credit balance after I enter this in on the debit side, it's now going to have a debit balance. So if I take this debit for allowance for bad debts, $2,700, and enter that here, that makes my total balance in this account after doing all of these is now $700 on the debit side. So I just took the $2,700, subtracted $2,000, that gives me my balance right there. Okay, and then I had a credit to accounts receivable right here for $2,700, so that will go right there. Okay, and now that I've done all of the required journal entries for the year, I can go ahead and get my total for this account as well. I can see on the debit side, it's pretty easy to add those two together. I have $140,000 on the debit side. I have roughly $77,000 here on the credit side. So obviously the debit side is going to be larger. So my balance will be over here, and I will just take these two and subtract these two. Okay. So I will let Excel do the math for me. Okay, so my debit balance now in accounts receivable is $63,000. And I have a $700 debit balance in allowance for bad debts. Okay? That records everything that actually took place during the year. Now, we're assuming we did this the last day of the year. Okay? Right before we're doing financial statements. So, what we haven't done yet for this year is we have not made an estimate for the accounts that became accounts receivable this year, how many of those are not going to be collectible, okay? This was our estimate from the end of last year. We need to do the same thing and estimate at the end of this year what the allowance for bad debt should be, okay? So we have in part 3 here, we're testing basically 2 of the 3 methods that we looked at. The first one, we're testing percent of credit sales and using that as the guesstimate for the allowance for bad debts. Okay, if you remember what we do to calculate that, we're given the percentage right here. Okay, I told you that before in class that I'll always give you the percentage. An actual company uses the history and the industry trends and whatever to calculate that. We just give it to you. So I need to take this 3% and multiply it times the number of credit sales I had for the year. That is given to me right here. Okay? So either, if you're tested on this, you're either going to get that number of net credit sales in part of the earlier part of the problem like we did here, or in the actual question it will say you had $80,000 worth of credit sales for the year. We've determined 3% of those are uncollectible. Using the percent of credit sales method, what's our estimate for allowance for bad debts? Okay. You also should remember that we're testing 2 of the 3 methods here. All 3 of the methods use the same template as far as the journal entry goes. So the accounts we use in this journal entry and in this one down here, which will be for 2 of the 3 different accounts, they will look exactly the same. They will just have a different number as the estimate. Okay? So for the percent of sales number, I'm just going to do $80,000, which was my net credit sales, times the percent that I'm given here, 3%. And that gives me $2,400 is my estimate of the amount of accounts of those credit sales I made this year that are not going to be collectible. Okay? It looks kind of backwards because, you know, for the year, we've already seen that $2,700 worth of accounts this year are not collectible. Okay? Part of that $2,700 is probably related to some of these sales that we made this year. Part of it is probably related to the beginning balance, the $60,000 that we had before. Yes? $2,400 was just net credit sales, which is given to us right here, or total credit sales, times the percent that we think is going to be uncollectible, which is given to us right here. So 80,000 times 3% gives us 2,400. The journal entry on the last day of the year just looks like this. Oops. Okay. Since we're using the percent of credit sales method, whatever number we get multiplying 80,000 times 3%, that's what goes in the journal entry, right? For the other two methods, remember you have to look at what the balance already is in the allowance for bad debts and use that balance to come up with the total we want to be in there. So this one's a little bit more simple to do. We just take the net credit sales times the percentage, and that gets plugged straight into our journal entry. So we have 2,400 debit, 2,400 credit. And they ask us also to, using all the information we have so far, fill in the T-chart after this journal entry for both allowance for bad debts and bad debt expense. Okay? So, looking back up here, we already have a balance in allowance for bad debts. Okay? This balance takes into consideration all of these transactions, and then we now need to add the effect of this journal entry to the T-chart. So I'm starting again with a balance of $700 on the debit side. Okay? On bad debt expense, there's nothing that happened in anything we've done so far, so its balance that we start with is just 0. So allowance for bad debts, I take this 700, I look at the effect from this journal entry, which was a credit for 2,400. And netting those two together, I get a credit balance of 1,700. Okay, this one's pretty easy. There's no balance in there. I just take the debit of 2,400, plug it in, and that also becomes my total for that account. Okay, everybody with me so far on how I got to that one? Okay, since this is a principles level class, I'm not going to ask you to recreate the chart that I put up and that I explained for aging of receivables. If you remember what that looks like, it had the time period 0 to 30 days, 31 to 60 days, 61 to 90, greater than 90. There was a different percentage that I think was going to be uncollectible for each of those time periods, and then you add it across the bottom to come up with a total amount that you think is going to be uncollectible. Okay? Instead of doing that, we just assumed that you already have the chart, you add across the bottom, and when you do that, you get $2,200. Okay? So we've already done the chart. It gave us a total target amount that we need to have in our allowance for bad debts of $2,200 for Part B. Okay? But that's not the end of the story yet. Okay? Because what that target amount tells us is that when we're done with the journal entry and the T-chart, the balance should be $2,200. Okay? That's what that target amount tells us. For the aging of receivables method and also for the percentage of receivables method, they both only give you a target amount. Then you have to look at what the balance already is in that account and determine what you need to do to arrive at the target amount. Okay? So in this case, it's going to be kind of like a simple algebra problem. We start with a $700 debit. At the end of the day, what we want it to be is $2,200 of a credit balance here. Okay? So you basically need to know, assuming if you wanted to change this to algebra, x minus 700 equals 2,200. Okay? So the amount that goes in the credit side needs to be 2,900 in this case, right? Because if I put 2,900 in there and I net those two together, my end result is 2,200. Okay? So remember, for aging of receivables and percent of receivables, the equation that you use to calculate the estimate gives you what the total in the account should be. And then you need to figure out what you need to do in the journal entry to get there. Okay? So again, for the journal entry, the template looks exactly the same as it did up here. Okay? You still have a debit to bad debt expense, and you still have a credit to allowance for bad debts. Okay? And we figured out that we need $2,900 of a credit in this account to get us to our target. So that means the number that goes into this journal entry is 2,900. Okay? With that number in there, we are able to arrive at the target that we need in allowance for bad debts. Okay? Which, since we use that for this journal entry, means that the debit to bad debt expense that it goes into this T-chart is also 2,900. Okay. Any questions on this? If I were to add another problem in here that said Part C and wanted you to look at percentage of receivables, okay, instead of aging of receivables, I would basically give you in Part C, let me put that up here, using percentage of receivables, we determine that, say, 5% of outstanding accounts receivable will, let's say let's change that to estimate. We estimate that 5% of outstanding accounts receivable will not be collected. Okay? So if that was Part C here, we're given a percentage. Whoops, I didn't put that percentage in there. Okay, yeah. We're given 5% as our percentage, and our equation basically says we take the percentage we're given, we multiply that times whatever the balance in accounts receivable is, which we determined in requirement 2. So we determined that the amount in accounts receivable was $63,000. Okay? So to get my target amount, like the $2,200 that was given to us in Part B, what I need to do is multiply the balance of accounts receivable, $63,000, times the 5% right here. Okay? So I would have 63,000 times 5%. Okay? That would give me a target of 3,150. So if that was my target, I would plug that in right here instead of the 2,200. I would find out what I need on the credit side to net out to 3,150. In this case, it would just be 3,850 here. And so you'd have 3,850 here, 3,850 here, and 3,850 here. Yes?
So with aging of receivables and percentage of receivables, you're finding the target balance, like backtracking with the numbers.
Exactly.
The first option, you don't do
With the first option, you just plug it. Once you put in sales times this percentage, you plug that straight into the journal entry. Okay. Any other questions? Okay, that's all you're going to need to know how to do for the quiz. Okay, if you take the one in class. If you do the second chance quiz, that will cover notes receivable and everything else, but it should be stuff that you can fairly easily look up in your book and answer that way. Okay, I will see you all on Wednesday. Everybody sign the attendance sheet. Yes?